You did call this. It is, however, 6 months earlier than might have been. Should the banks be just a little concerned that perhaps the worst case scenario wasn't enough?
Well, Bonnie and Amanda, thanks for having me back. I was on last week. We upped our earnings estimates, but not for this factor. So this is a surprise. I think this is a key marker for large banks that they're on the road to redemption from the global financial crisis. So this was the harshest Fed stress test yet. They have unemployment almost 2 times the current levels. They had stress scenario losses of $600 billion. That would be 1/3 of the industry's equity. And banks still have, under the stress scenario, equity 1/3 above the minimum. So, no, I don't think they're overdoing it. I think this is a very harsh scenario. And even after this theoretically harsh scenario, banks still have plenty of capital to support customers and return capital through buybacks, which were suspended by the regulators for the last 9 months. So this is good news for bank stock investors and well earned by the banks. And I will say, what a night and day change from the global financial crisis or even the recession in the early 1990s.
Yeah.
At this stage of the recession, when you talk about banks, normally you're talking about how are they going to raise capital?
Well, yeah, but Mike,
right?
we can't ignore the fact that they got a lot of help to get out of the great financial crisis, and that this is 10, 12 years later, so...
Yeah, so actually you say congratulations to the regulators for ensuring that banks have enough capital and liquidity, and it's been a long, hard road, and banks aren't fully out of it by any means. Look at their stock valuation. So there still is this recency bias left over from the global financial crisis. So banks were the cause of the global financial crisis, and in this case, banks are part of the solution in resolving this pandemic hurting economy. So, but this is a major milestone. I mean, we can call this Fed Friday when it comes to bank stocks, because now that we had Fed Friday and we were working late Friday night to go through the numbers, this is a marker to say, banks are resilient, they are stronger, they can withstand a level of losses, far beyond what people had.
Let me jump in.
Thought they could absorb.
Mike. So we should though be, not to be overly cynical, but there are more bank lobbyists in D.C., they say, than there are members of Congress. This is a very influential group. I'm surprised, I think, that it wasn't priced in better. The Goldman's getting a 6-7% move on this is a bit surprising to me. But I guess the real question is, are the banks playing the role that they need to play? They're returning capital to investors who are already enriched through this whole process and central bank easing. Will they play the role we need them to play in putting money in the hands of small business people and entrepreneurs over the next 6 months to a year?
Well, I don't think you're being cynical at all. I mean, I write about this in my book, Exile on Wall Street, about the power of the large banks and the lobbyists to influence Washington, D.C. On the other hand, the other side is demonizing banks. So I think there's a nice middle between, getting non-tribal. And I think that's where we're going, having Janet Yellen as Treasury Secretary elect, it's a more non-tribal attitude, more pragmatic role. So, yes, the Fed reduced interest rates, and that helped capital markets, but it also hurt bank net interest income, the traditional banking revenues, by $50 billion year over year, and we've done the math on that. So I don't think there's you can be cynical and say, hey, this was in the interest of banks to go ahead and do this. On the other hand, you can say, the Fed still left in some optionality to say if the Fed wants to change their mind after the first quarter, they can change their mind. They also said banks cannot increase their dividends to above the level where they were in the second quarter. They also didn't change the minimum capital requirement. Right. So this was kind of the way I see it, a compromise solution where the Fed maintains optionality, but also allows banks to return some of this excess capital, which is the highest level in modern history as defined by regulatory standards.
Just real quickly, I mean, we never forget, right, the famous Alan Greenspan, I thought they wouldn't put themselves in jeopardy, I'm paraphrasing, but the big banks, they can get themselves back into trouble at any time. Just quickly, Mike, which of the banks do you favor? For investors who are now looking and saying, I want to get on this bandwagon, which ones do you like the most?
Well, I just want to make the point that, due to regulators being tough, this has been a decade-long process to getting banks on a strong foundation. But right now, we think Goldman Sachs has revitalized itself. We think Goldman Sachs stock hits an all-time high, over the next few quarters. We think short-term, medium-term, and long-term, they're in a very strong position. And more than ever before since 2009, we think Goldman Sachs is Goldman Sachs as they facilitate financing, from, not, it used to be from trader to trader. Now they're looking from client to client. They're taking their mind share,
right,
all those, dinners they have and everything else, and translating that into market share. So Goldman Sachs is back. And so that's probably the best way to play this. They're the biggest beneficiary of the Fed stress test. And I'll repeat myself, I think they go to an all-time high in the not-so-distant future.